My name is John Ross with Finance on a Budget. In this video, I'll talk to you about how you can properly handle assets and inheritance, preferably before your loved ones have passed. Yes, it's a pretty touchy topic, and most elderly members will likely give you a hard time whenever you try to bring it up. But the truth is that being prepared is absolutely necessary, otherwise it's one of those things that will give you headaches if you don't try and plan ahead. Before we get into this, I need to point out that I am not a lawyer, nor am I a financial advisor. I'm just some guy on YouTube doing the research and passing along the information that I find. You might think that your parents' retirement plan assets like IRA, Roth IRA, or 401k are automatically rolled over into your own IRA. But the truth is, non-spouse beneficiaries will have to take the required minimum distributions, RMDs, over the course of the next 10 years. While spouses can take advantage of unlimited marital deductions, children and siblings can't. The best thing they can do is to make sure that they are named directly as beneficiaries of the IRA, 401k, or Roth IRAs. The IRS doesn't allow you to roll money over from an inherited IRA into one of your own existing IRAs. Instead, you'll have to transfer a portion of your assets into a new IRA and formally named as an inherited IRA. No additional contributions are allowed in the new inherited IRA account. Instead, you have 10 years to empty this account out in full. Sometimes when a plan is a 401k, employers can even force non-spousal beneficiaries to use the 5-year rule, which means that you have to empty the entire account by the 5th year after death. This supersedes the previously mentioned 10-year rule. Oh, and by the way, if your surviving spouse is the main beneficiary, but it makes more sense to pass it on to the children, then the spouse must give written consent to relinquish any claim of the funds to the children, so it's important to talk about it beforehand to avoid any nasty squabbles within the family. Roth IRA beneficiaries can withdraw contributions tax-free at any time. Note, here we are talking about the Roth IRA contributions. Earnings from the inherited Roth can also be withdrawn tax-free as long as the account has been open for at least 5 years at the time the account holder died. If the Roth IRA is less than 5 years old at the original owner's death, you'll owe taxes on the earnings if you withdraw them as well. When to take out IRA distributions. The SECURE Act started on January 1st, 2020 and brought several changes to the rules about retirement accounts. In general, it requires you to withdraw all of the money over the next 10 years. However, there are a few exceptions. If you inherited the IRA from a spouse, you can transfer the full amount into your personal IRA as if it was your own. If it's a traditional IRA, required distributions start when you reach 72. If you're a minor child, then you must start distributions at age 18. You will then have 10 years to withdraw the entire amount. If you are chronically ill or disabled and you meet a strict IRS definition, you can stretch out the IRA distributions throughout your entire lifetime. If you are less than 10 years younger than the account owner, then withdrawals can be stretched out over your lifetime. This often applies to siblings, but unmarried couples may also meet this exception. If you have a workplace retirement plan or your own IRA, consider using your inherited IRA withdrawals to cover your living expenses. That could then free you up to contribute more of your earned income into your own retirement plan. If you qualify, you can put as much as $6,000 per year and up to $19,500, $26,000 if you're 50 or older, into a 401k. Inheritance, creditors, and bankruptcies. Let's say you owe a bunch of money to old credit cards, loans, or repossessions. If those creditors find out, they can put a claim on that money. All they have to do is wait for you to file for bankruptcy. While you may be thinking that your newfound wealth will be protected, then surprise, it may not be. It will likely be considered as a cash account, and it can then be used to pay them back. With it will come all of the penalties and tax burdens previously mentioned. So if you're thinking that you may be getting an inheritance kind of soon, then you really need to get any bankruptcy stuff out of the way before anything happens. Otherwise, creditors may get more of that money than you. The money is not exempt from attachment by creditors under the Bankruptcy Abuse Protection and Consumer Protection Act of 2005. This video was just scratching the surface of your inheritance. I have a part 2 of this video, linked below, that covers more inheritance topics and what it means to be a guardian for your parents. Personally, I found this whole topic fascinating and dedicated extra resources into collecting the most important topics. Be sure to give this video a like, subscribe, and ring that notification bell. Thanks for watching.